What's up, everyone? It's Professor Reiko here, and today we are kicking off our lessons on inventory. All right, so both the Spiceland and the Kiso book both have your inventory broken into two different chapters. It's chapter 8 and 9, I believe, in both of them. So what I'm going to do is I'm just going to keep all the videos under one heading under inventory. So there'll probably be several of them. This first one here is just a brief introduction to get us started before we really get rolling into the chapter. So let's get going. So most of you guys are well aware inventory are assets, okay, and they're assets that are held for sale just in our ordinary course of business, okay. It often, many times, is a rather large number on the balance sheet. If you were to look at Home Depot or Walmart or anybody like that, I mean, inventory is a huge, huge number on their balance sheet. All right, so you kind of have to break things up between a merchandising company here, which I always usually refer to as retail. So when you see retail company, they typically don't make their inventory. They're going to buy it from somebody else, put it on their shelves, mark it up, and then sell it to the customers. All right. So if you think about Walmart or Home Depot, everything in Walmart and Home Depot is manufactured by somebody else. Okay. Walmart buys it, puts it on their, marks it up, puts it on their shelves, and then sells it. Okay, a manufacturing company is a company that produces its own stuff to sell. Okay, so they are typically their inventory, and this goes back to your managerial or cost accounting classes, depending on what you've already taken so far. But you would have seen these terms: raw materials, work in process, and finished goods. As it goes through the production process, becomes finished goods inventory that can then be sold, oftentimes sold to one of the merchandising companies. All right, so with inventory, you start each period with a beginning balance, okay? Which if you look down here at this setup down here, this is a good little formula to remember. All right, so you start with a beginning balance, which is your beginning inventory, and remember this is last period's ending inventory. Okay, so last period's ending is this period's beginning, right? That should make sense. All right, and then you buy or manufacture more inventory during the period. All right, so we're going to add in what we purchase. Okay, we'll just assume we're a retail company. Add in what we buy during the year. Okay, so we start with the beginning inventory. All right, we add some more to it based on what we bought. Okay, the total of these number gives us how much we have available to sell. So I call it goods available. Sometimes you'll see this called good. I'm just going to abbreviate GAFS, goods available for sale. All right, so we start with the beginning inventory, we add some to it. That gives us the total pool of what we have available. Okay, so of this amount, here's kind of the important sentence: you either sell it or you still have it. All right, now there's other things that could happen. You could have theft and this and that. Let's not worry about that right now. I'm just saying in general. So of what you have available, you either sold it or it's still sitting there. So you can, if you read down here below, it even talks about how we can switch that these two numbers can be switched in the inventory and cost of goods sold. All right, meaning in this example here, so if I have 59 available and I've got 23, all right, left over. So this is the number on the balance sheet for inventory. That'd be my ending inventory. So I had 59 available during the period. I've got 23 left at the ending period, which means I had to have sold 36. Okay, so that would be the number on the income statement for cost of goods sold. All right, I could have switched these two and said, all right, if I have 36, if I had 59 available total, I sold 36 of them, then I must have 23 left over on the balance sheet, okay, as my ending inventory. All right, so bottom line here is of the goods available, they are either sold or are still sitting in your inventory at the end of the period. All right, so this formula to me is a good one to know. I think it helps me get through a lot of things, like conceptually working through how much inventory I have, what was purchased. Because an easy multiple choice question, just let's take a minute since this is a shorter video, is I could ask you, I could give you some of this information and say how much was purchased during the period. And it means you would just have to know this formula and work, back up to that number to get to it. Okay. So if you know that formula, and remember, if you just talk through it, all right, we start each period with what we had left over at the last period's ending inventory. So that's our beginning inventory. We add to it by buying more inventory. That gives us how much total we have available to sell. And of that amount, we either sold it or it's still sitting there. Okay, so if you just kind of talk through it, that should help you understand this formula. All right, so the next video we get into, we'll start getting into periodic and perpetual inventory systems, then start getting into how to account for those, difference between the periodic and perpetual, and then we'll gradually work into inventory costing, the FIFO and LIFO and average cost and all that stuff, which is a big chunk of the chapter as well. Okay, so we're just going to take it bit by bit and work through both the 2 chapters on inventory all together here in this inventory section, and I'm gonna have all the videos just under this one playlist. Right, so tune in next time. We'll really pick it up and start rolling through the chapter. All right, see you next time.